Now, I know what you might be thinking. IFRS 11. Sounds complicated, but trust me, by the end of this video, you'll have a crystal clear understanding of what it's all about. First things first, what exactly is a joint arrangement? Imagine two or more parties decide to team up for a specific business activity. The key here, according to IFRS 11, is that they have joint control. This isn't just about owning a piece of the pie. It means all the parties must agree on the key decisions that affect the venture's returns. Think of it like a business partnership, where no single person can call all the shots. Without this unanimous consent for strategic decisions, it's not a joint arrangement under IFRS 11. It's that simple. Joint control is the magic ingredient. Now, once we've established that joint control exists, IFRS 11 splits joint arrangements into two distinct types: joint operations and joint ventures. This is where things get really interesting, because how you classify the arrangement determines how you account for it. Let's start with joint operations. In a joint operation, the parties known as joint operators have direct rights to the assets and obligations for the liabilities relating to the arrangement. It's like you and a friend owning a delivery truck to run a business. You both have a right to use the truck, and you're both responsible for the fuel costs and maintenance. In your own financial statements, you would account for your share of the truck, the asset, your share of any loans for it, the liability, your share of the revenue it generates, and your share of the running costs. You're essentially recognizing your direct piece of the action. On the other hand, we have joint ventures. This is a bit different. In a joint venture, the parties have rights to the net assets of the arrangement. This usually happens when the arrangement is structured through a separate legal entity, like a company. The parties, called joint venturers, don't have direct rights to the individual assets and liabilities of that company. Instead, they own a share of the company itself. Think of it as owning shares in a business you started with a partner. You have a claim on the company's profits and net worth, not its individual office chairs or bank accounts. So, how do you account for a joint venture? You just recognize a share of the assets and liabilities like you do with a joint operation. Instead, IFRS requires you to use the equity method, as described in IAS 28. Under the equity method, your initial investment is recorded at cost. Then, your share of the joint venture's profit or loss is recognized in your own profit or loss, and your investment account is adjusted accordingly. It's an indirect way of reflecting the venture's performance in your own books. So, to recap the key difference, joint operation means you recognize your share of assets, liabilities, revenues, and expenses directly. Joint venture means you recognize an investment and account for it using the equity method. The deciding factor isn't just the legal form, but the contractual rights and obligations of the parties involved. And that's the essence of IFRS 11. It all comes down to identifying joint control and then determining whether you have rights to the individual assets and liabilities or rights to the net assets of the arrangement. It's a logical framework that ensures financial statements reflect the true substance of these collaborative business activities. I hope this breakdown has made IFRS 11 much clearer for you.